Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing our stock market weekly recap. So this week, we're going to be covering the three major indexes, my portfolio changes for the week, any dividends that was paid out, the trades that I made this week, either for the short term or kind of swing trading. We're also going to be covering very quickly the GOB tax brackets that change, the long-term, talking a little bit about long-term capital gains and taxes with those, and then taking a look at some different stocks that I've maybe looked into a little bit to add to my Roth IRA. And they're going to be taking a quick look at Market Pro, talking about one of the stocks that I made this week and one of the mistakes that I made when buying the stock. So very quickly covering this information because I had already released the video Saturday morning, but someone had left a comment that the audio was not working, and now I have verified the audio is working during this recording. So the weekly index changes for this week, we had the S&P 500 move up by 0.28, the Dow Jones had an increase of 0.42, and the NASDAQ had an increase of 0.34%. So very nice increase, about a third from what last week's was. Last week I had over a 2% gain. This week I fell back a little bit by 1.29%, but a lot of it was due to one of the stocks that I purchased this week had fell after buying in nearly 9%, I believe. So we're going to be covering that here in just a minute. So my portfolio did fall a little bit behind this week in comparison to the other indexes, but that's completely fine. I think for the following weeks it should rebound and continue on. So as far as weekly dividends this week, I was not paid anything inside my retirement account or my non-retirement account. So the total dividends for this week is $0. I believe for the month of November, I'm completely finished with dividend payouts. There may be a few swing trades that will be coming in towards the end of the month, but it shouldn't be too much. I think I'm right around $205 for the month of December, which didn't beat my previous max of $208 in November. As far as weekly trades, I'm going to change this to weekly trades because it's going to just kind of talk about not all the swing trades, but just all the trades in general. So I only buy dividend stocks that I've kind of prepped for and investigated. And what I did is inside my non-retirement account, I had some money left over. I couldn't transfer it into my retirement account because I've already capped out my retirement account. So I went ahead and purchased 2 shares of CenturyLink for $17.23, which averaged down my initial purchase of CenturyLink. And these are just kind of buy and hold for the long term. And then I made my big purchase of EIX, which is Edison International, at $70.55 on the 18th of December. Their ex-dividend date is coming up on the 28th, which is Friday. It's Thursday. So I bought these to kind of hold for the long term and will continue holding this for the long term. But I did make the mistake of purchasing them a little bit too soon. I pulled the trigger on it and bought them at what I thought was considered a very low dip. But they did fall down a bit deeper or lower where I bought them again. Just a share there, just kind of buy it into the stock I had already researched and wanted to buy more of on the dip, but it continued to fall. So as far as profits for this week, my portfolio didn't get any profits as far as swing trades or trades. I didn't make any dividends this week. So this is just primarily from buying into some stocks or what my portfolio did. It kind of fell back by 1.29%. And I'm going to talk a little bit about over here at Market Pro, just the stock that I bought. So if we jump right over here, I bought Edison International on the 19th at $69.60. So over here at Market Pro on the 19th, you can see over here is the date. So we look for the 19th, which is right in this area. So I was watching this huge 14% dip right here. So I was like, okay, you know what? I had to buy on this dip. I think it's a great stock. It'll rebound. The only reason it fell down 14% is because the California wildfires, they had a little bit of a lawsuit in that, but I decided to buy them at around $70.55, and for the next day here, they were trending up, and then come Thursday after hours, they had fell down by quite a bit, dropping by more than 6%. So I should have waited. Initially when you're buying into a stock for the long term, I thought it was a great deal at $70.55. So I just put all the amount that I had into it. but I should have only put 50% of my initial purchase and then bought in on those dips, because I still have another like 4 days until the ex-dividend date. So I should have waited. My bad. My mistake was I put in the full amount too early, and I could have bought in at the $63 mark where it dipped. But that is unfortunate that I did miss out. You can see that there was a pretty big sell-off in the. You can see the volume here is in the thousands, hundreds, 25,000, 19,000. There's a bigger number somewhere in there, but very big sell-offs right out this time right here. You can see 84,000, just huge amounts of volume. And then right here, there's a huge buy and back, and then towards the end of the trading day on Friday, they begin to buy back into the stock. So this stock's going to be trending up nicely in the next following week, recovering at least this last 6% loss that I did take. And you can see the trades that I initiated here. I had doesn't see the amount, 47 shares of EIX within my Roth IRA, and then I had 1 share of EIX, which is Edison International, inside my non-retirement account, and then my CenturyLink purchase inside my non-retirement account. And that's because my non-retirement account, I can put as much money into that as I want, and I can get, that's where my first portfolio was, but my retirement account is actually capped for the week or for the year, and I can't put any more money into it. I can only receive dividends and use those dividends to reinvest into, inside of that account. But at this time, I only have 12 cents remaining inside my Roth IRA, which I can't currently use. So that is primarily the trades that I made this week and the mistake that I had made. Now, talking very quickly about some of the GOB tax bill changes, the 3 big brackets, the 3 basic brackets, they fell down by 3%. They still kept the 7 brackets that they originally had. The whole thing was that they were going to try and change it to a 4 bracket, bumping up the minimum to a 12 and bumping down the top from a 39 to a 37, and then bumping the 25 and the 28 down into, I believe, a 15. But they decided to kind of keep the existing 7 brackets. They deducted 3% from the 5%, the 25%. The 28% fell down by 4%. So they had the biggest break right there in this frame right here, between 82,000 and 157,000 if you're single. And then down here, I'm married, so the 15% bracket, it fell down into the 12%, getting taxed at. So that's a nice little 3% deduction in my taxes. I think everyone should pay less taxes. Taxes themselves haven't been around for more than 100 years. They started taxing people back during the initial World War to cover war expenses. But my whole goal as far as taxing goes is I try and get taxed at the 15% tax bracket or less. So as far as my adjusted gross income, I try and keep it below 77,000. That means if I make, between me and my wife, over 100,000, we try and contribute to our 401ks, our IRAs. That way our taxable or our adjusted taxable income is below the 77,000 mark, because then we would only get taxed at the 15% tax bracket, and that goes into the long-term capital gains, which, if you look at long-term capital gains, if you fall into this married filing jointly or single, if you are single and make adjusted gross income below 38,700, or if you're married and make below adjusted gross income 77,400, then your long-term capital gains, your dividends, do not get taxed. You don't have to pay any taxes on those things. So that's one of my goals, is to stay within the minimum bracket, either through contributing to my IRA or my 401k, up to the whole amount that I need in order to adjust my adjusted income below the specific cap. And this isn't for Trump. President Trump had signed the GOB tax bill on Friday. So we're going to be, it takes a full month to get read. I don't think anyone out there has completely read it to a T. So they're going to be taking January to kind of go through it, make 100% vote, or 100% kind of like writing all these rules down, and then it's going to be for sure written up on the IRS website for everyone to kind of see and kind of check out. Now I'm going to be taking a look at REITs going forward. There was a little snippet in here that was adjusted here. There's an amendment to the original tax reform. So there's a little snippet in here. Now REITs are not normally taxed. There's no tax deductions on REITs. They're normally taxed at not long-term capital gains. They're not qualified. So in this case, there are some qualified REITs, and normally you have no deductions, but in this case, there's a little snippet in here. So they're going to be going from a 0% deductible to a 23% deductible. And for clarification, that means that if you make $10,000 in qualified REIT dividends, that results in a $2,300 deduction towards one's taxable income. So your actual qualified REIT dividends, you'd be able to get a tax break from that, which is something that you've probably never seen in the past. So that's, I'm going to be taking a look at REITs within my Roth IRA, within my wife's Roth IRA, because REITs, it's a lot of income. If you have them inside your non-retirement account, which I have my O and my EPR, those get double taxed. The company gets taxed, and then I get taxed on my regular income bracket. So I don't want to do that. I'm trying to look to move them into my Roth IRA where they won't get taxed. And then as far as summary goes, there's a wrapping up session here that just talks about how qualified REITs will get provided a 23% deduction towards taxable income. Capital flows could move toward REIT as this change makes investments more viable in taxable accounts, which presently holds very few REITs as a percentage of assets. Economic stimulation should help the same-store NOI. This is the net operating expense or something along the line. Net operating something. It's not expense, it's something else. And REITs are one of the few structures that retain full deduction of interest expense. So that is basically it. All three of these articles, the GOB tax bill, find out your bracket here, find out what your bracket is. Try and make an estimate as to next year if you need to be contributing to your 401k or IRA in order to drop you down into a 50% bracket for your single or married bracket. And then take a read through the long-term capital gains, because you don't want your long-term capital gains in stocks or in dividends to get taxed. You want to try and save that money for the long term. And then if you are interested in taking a look through the REITs and how they're being transformed a little bit with this tax reform bill, go ahead and take a look through this article. It's pretty long, but it has some really good information, which I took a little bit of a couple reads through. And then that is primarily it for this week. So that is it for this week. If you've stuck around this long, thank you guys for watching. If you're brand new to my channel, go ahead and hit the subscribe button on the bottom right hand corner. You can get subscribed to my channel. If you are an existing subscriber, thank you guys for watching, and that is it. Have a great day. Bye-bye.